In the lower tax brackets, silence is perceived as a void, an awkward gap that demands to be filled. But climb high enough up the socioeconomic ladder and the physics of communication invert completely. At the Berkshire Hathaway level, silence isn't just golden. It is a defensive moat. It is an asset class. It is survival. We live in an attention economy that rewards noise. Or so you've been told. But check the ledger. When a CEO speaks, the market doesn't just listen. It calculates risk. Every syllable is a variable. Every opinion is a potential liability. History is littered with executives who didn't understand the price of a microphone. But today, we are analyzing the divergence of two fortunes. One built on the compound interest of patience, and the other, perpetually leveraged against the volatility of an ego that refuses to shut up. Enter Elon Musk, the anomaly. To the retail investor, he is a visionary. To the risk analyst, he is a walking, breathing volatility index. When Musk acquired Twitter for $44 billion, the media called it a tech acquisition. They were wrong. In the cold light of valuation, he didn't buy a social network. He purchased the world's most expensive megaphone, and he has been paying interest on that purchase ever since, not in cash, but in stability. We have watched billions in Tesla's market cap evaporate in pre-market trading, simply because the Technoking decided to engage in a culture war skirmish at 3 o'clock a.m. This isn't about stupidity, it's about unmanaged beta. Musk operates on a philosophy of total exposure. He believes his personal brand is the liquidity that fuels his companies. And for a long time, he was right. But there is a law of diminishing returns on controversy. At a certain altitude, being the loudest voice in the room stops signaling strength and starts signaling instability. While Musk is busy winning the argument, he is slowly, but surely, losing the war for the one thing money can't buy: predictability. Shift your gaze from the silicon chaos of Texas to the quiet, rain-slick streets of Omaha. Here, Warren Buffett plays a different game. He understands a truth that the new guard has forgotten. In a hyper-polarized world, opinion is a toxic asset. There was a time when Buffett would dip his toe into the political waters, but he watched the world change. He watched as discourse devolved into tribalism. He realized that half the country doesn't just disagree with the other half anymore, they despise them. Buffett identified tribalism not as a social issue, but as a business cancer. To take a side is to immediately alienate 50% of your potential customer base. It is mathematically impossible to compound wealth efficiently when you are actively inviting half the market to bet against you. So, he did something radical. He shut up. He stepped back. He realized that the most powerful statement a man of his influence can make is to refuse to play the game at all. But the silence isn't just about stock prices. This is where the calculus becomes moral. When a billionaire speaks, the consequences are rarely felt in the boardroom. The shockwaves travel downstream. Buffett owns businesses that live on Main Street. Dairy Queen, Geico, See's Candies. He realized a terrifying dynamic. If he insults a political tribe from his ivory tower, the blowback doesn't hit him. He has private security. He has gates. The blowback hits the 19-year-old cashier pouring a blizzard. It hits the insurance agent trying to close a deal in a rural town. They are the ones who have to look a customer in the eye and answer for the CEO's arrogance. This is the collateral damage of the loud CEO. Every time Musk sends a tweet that antagonizes a demographic, he is drafting his employees into a culture war they didn't sign up for. He is spending their social capital to feed his ego. Buffett's silence is not cowardice. It is a shield. He denies himself the luxury of speaking his mind so that his 300,000 employees don't have to pay the price for his opinions. That isn't just risk management. That is leadership. Let's strip away the politics and look at the math. In the world of probability, expressing a polarizing opinion is what we call an asymmetric risk, and not the good kind. It is a trade with a capped upside and an infinite downside. Here is the equation. If a CEO publicly endorses a candidate or a cause, the customers who agree with him might nod in approval, but they don't buy 2 cars. They don't buy double the insurance. The revenue upside is effectively zero. Loyalty is static. But the customers who disagree, they don't just shrug. They organize. They boycott. They cancel subscriptions. The downside exposure is 50% of your market. In statistical terms, taking a public stance is equivalent to picking up pennies in front of a steamroller. Musk ignores this probability distribution. He bets that his tribe is strong enough to offset the losses. Buffett, the actuary at heart, looks at those odds and folds his hand. He knows that in business, you don't need to win every argument. You just need to not lose your customer base. But perhaps this contrast isn't just about personality. It is about the structural engineering of their wealth. We are witnessing a clash between two different valuation models. The narrative vs. the tangible. Musk plays offense. Tesla and X are valued not just on current earnings, but on future promises. Robotaxis, Mars, Augie. This is a hype-based valuation. To sustain this massive multiple, Musk must generate noise. He must be the main character of the internet. Silence, for him, looks like stagnation. Buffett plays defense. Berkshire Hathaway is built on railroads, energy grids, and insurance floats. These are tangible assets. They move physical goods. They don't run on tweets. They run on diesel and actuarial tables. Musk's strategy is high maintenance and high anxiety. He is on an infinite treadmill of attention. Buffett has achieved the ultimate luxury of the ultra-wealthy, the freedom to be boring. His silence is proof that his business works without him having to sell it every single day. There is a profound irony at the summit of capitalism. We are taught that money buys freedom. We assume that $100 billion buys you the right to say whatever you want, whenever you want. But the opposite is true. Freedom of speech is a luxury reserved for the anonymous. It is a privilege for those who have nothing to lose. Once you become a publicly traded entity, your voice no longer belongs to you. It belongs to the shareholders. It belongs to the board. It belongs to the ticker tape. Elon Musk is fighting a war against this reality, trying to buy back his voice for $44 billion. But Warren Buffett accepted the terms of the contract decades ago. He understood that the price of absolute power is absolute silence. To speak is to be human. To be silent is to be an institution. Buffett chose to be an institution. Musk is still desperately trying to remain human, with all the messy, volatile flaws that come with it. In the end, the market will decide which strategy wins. Musk offers the thrill of the gamble, the dopamine of the spectacle. He builds history, but Buffett builds legacy. While the world screams for attention, arguing over the latest outrage, the Oracle of Omaha sits in the shadows, letting the magic of compounding do the heavy lifting. He knows that true leverage doesn't require a megaphone. So, the next time you feel the urge to broadcast your opinion to the world, remember the silence dividend. Because in a room filled with noise, the most powerful person isn't the one shouting to be heard. It's the one who is quiet enough to hear everything. If you want to understand the language of power, join the archive. We'll be waiting.